I'm the only but that is okay. I actually like it a lot. Oh, lost my lost my full PowerPoint there. Okay. And this picture has actually changed. We've had a couple attorneys leave and we've added some new members to our team as well. So hopefully at some point we'll take a more updated photo, but that's just some of us. So estate planning 201, talking about all these fun things. So I'll just jump right into our first topic, which is the revocable living trust. So also known as the RLT. And I also just wanted to mention, sorry, before diving in, I know we said we could wait and do things. I can answer anyone's concerns at the end or talk about personal things. But if anyone wants to ask anything, or if I'm kind of throwing someone off, and you want to chime in now or at any point during my talk, please feel free. It's such a small, such a small number of us that would be perfectly fine. So don't be shy. So like I said, our first topic is the RLT, so the revocable living trust. So this is essentially an entity, right? So similar as to how your will controls your probate assets, this is for non-probate things. You can fund an RLT with anything almost. A common asset to fund it with would be maybe some bank accounts or a house or something like that. And obviously you'll see the primary benefits. You avoid having to go through the surrogates court to have it, to have essentially the court have oversight over it. And that, once it's set up, it's not deemed invalid in the event that something happens to you in the future. So it will survive your potential incapacity at a later date. And then obviously it says, because if you have something like this set up, you might not even have to use your will if all your assets are funded into something like this. So let's take a step back, right, and say, why would people do something like this to start with? I usually recommend that people set something up like this if maybe they plan to disinherit someone in their family, because if you're going to disinherit someone under a will, they would have the right to, object to that will. But if you do it under this, there's no court process. There's no need to have a court, hearing or anything. And so it would give the person you're disinheriting essentially no venue to challenge that. Another common reason why someone might have something like this in place is if they own a house or own land or something like that in a different state, because you don't want to have to probate a will in multiple states. So that's another common reason. So you would fund that house or fund that land into this, and then it would just pass upon your death pursuant to the terms of the RLT itself. And then the third option, and we'll kind of touch on this more as we dive further in, is if you have an estate tax issue. And at the federal level, a single person is not going to have any estate tax issues. So you're not going to owe any estate tax unless you have over $12 million of assets. And if you're a married couple, again, at the federal level, you get to combine that. So you get a combined net worth of over 24 million before you have any estate tax issues. But every state, well, I shouldn't say every state, but a lot of states also have their own separate state tax as well that you might have to pay upon your death. And that threshold is often much lower. Here in our state, that is just over $6 million. So I often am meeting with people that are either right at that threshold or maybe, a little under it, but they're still young and they might reach that by the time they're in their 70s or 80s. And so the idea being, let's just, for example, say it's, two spouses. The idea would be they each set up their own RLT and then essentially split all their assets, half into, one person's and half into the other person's. And then upon the death of the first spouse, they're not going to give everything to their spouse that's still living, they're going to pass it on right to either their kids or their family or to whatever, person they want it to pass to. And then you avoid, like I said, that estate tax issue. So those are kind of the most common reasons why someone would have this kind of planning in place. I would say I personally recommend it the most to people when they're trying to disinherit someone. For example, I have someone who completely disinherited her only son, and he's pretty hostile, and we didn't even want to give him the opportunity to contest that upon her death. And so we did something like this instead. And we actually set up all her bank accounts to be payable on death to the RLT. And that way we avoid having any assets in her probate estate at death, meaning we don't have to use a will, we don't have to go to the surrogate's court or anything like that. So son, again, as assuming this all works as I planned it, which it should, but there will be no venue for son to essentially challenge that at all, which is the goal behind that kind of planning. Any questions about the RLT? And again, you don't have to speak now. If you want to wait until the end, that's perfectly fine.
Brad, this is Randy. If I may, a couple questions.
Absolutely.
What grounds would a disinherited person have to successfully challenge a will?
So that's a great question, Randy. So again, probably varies a little bit by state law, but here in my state, there's really only a few options. You're going to either claim undue influence, meaning, someone was really forcing mom to like sign this will, or, they were interfering in mom's thought process. Fraud would be the other big one, meaning that wasn't her that signed that will. Someone forged her name or something like that, which you almost never deal with. And then the third one is lack of testamentary capacity, meaning that she was not in her right state of mind, or she wasn't, fully there at the time that mom signed that will. That's the one that people usually try to go after the most, because it can be the easiest to prove, if you talk to the doctors and you go through all those hurdles. But with that said, any will is going to be presumed to be valid as long as it was witnessed by two disinterested witnesses, and then those witnesses signed a separate statement saying that they witnessed the will at the request of the testator, the person that signed it. And it's a high hurdle to meet in order to then shift that burden onto the proponent of that will who's trying to offer it to the court. And so, like I said, it is a very high burden, and more often than not, these things are settled outside of court, just because no one wants to go through the expense of actually, paying for attorneys to duke it out over these types of things.
Right. I could see where even if someone was not likely to be successful, just the expense and the time and the hassle, you might want to avoid that.
Right. Exactly. And usually that's what's happening, is that it's people that know that they're probably not going to succeed when all is said and done. But usually the other parties involved are willing to give them something to essentially just, go away.
Right.
But, if you want to avoid all of that, then you would do something like this, RLT, for example.
Okay. Second question, and then I'll let you move on. Don't mean to delay, but
Okay.
you mentioned the federal estate tax rule that for a couple who are looking at $24 million estate, value of an estate before federal taxes kick in on it,
Yep.
which is a huge number. So, my way of thinking, nobody I know or ever going to meet is going to have to worry about the federal estate tax rule under that rule. But is that for the foreseeable future, or does that phase out in the next 10 years? So many of these tax rules are changing.
That's a very good point. Yep. And Thank you for asking, Randy. So as some people might know, that number really did take off and go like way sky high, thanks to the Tax Cut and Jobs Act that was passed. I believe it was either 2017 or 2018. That threshold, that high threshold, is set to sunset. I believe it's in 2027 or 2028. Don't quote me on that exact year. So it's not necessarily set in stone, and it will likely, unless they pass it and extend it, go back to pre-Tax Cut and Jobs Act threshold, which was more in line with our state's threshold, which is around that $6 million. And it does increase every year because it adjusts for inflation. And I think it should go without saying too, maybe, that this is all, it might vary based on who's currently in the White House, who has control over Congress, because, I think certain members of certain parties want to really expand that tax and have it just be even higher, so that no one has to pay it. And then I think there's a growing number of people that want to really rein that in and maybe bring it down to even under 6 million. So there's a lot to watch for in that. And so part of planning as well, kind of factors in, maybe, even though this is where we're at now in terms of, you've got at least $12 million if you're married, again, twice that. That's not set in stone, and that might be brought down.
Okay, and Jerry asked a question in the chat, what the New York estate tax thresholds are, and I think you just answered that by saying about 6 million.
It's just over 6 million, and the big thing for here is that, unlike at the federal level, you do not have what's called portability, meaning you and your spouse cannot combine. So you're stuck with that 6 million figure. You don't get to combine with your spouses.
Okay. Okay.
So
that's the reason then why you would have two then trusts, because I'm familiar with the one family trust, so that would be the reason for two. Okay.
That is correct. Yep.
Thanks, Brad.
No problem at all. I guess I didn't really touch on it, but typically the terms of the RLT would read similar to what you might see in a will, right? Upon the death of the second grantor, that's what we call the people that form these types of things. These assets pay out, to XYZ, or I give this specific asset to, I don't know, my niece or my daughter. It's meant as a testamentary substitute. So again, the actual terms that you'll see in it will kind of read similar to what you might see in someone's will. The only difference is that it's handled outside of the surrogate's court. You don't have to actually go through that court process. I think that's all I have to say about RLTs, unless there's any other questions right now. But I'm gonna skip my slide to the next. And we're talking about the irrevocable Medicaid trust now. So when people hear the word trust, more often than not, they're thinking about something like this, because they either talk to their neighbor down the street, or their mom had something like this, or someone knows someone that had this type of planning done. And the main benefit, as you might tell, or as you might be able to tell by the title of my slide, is that it will save on expenses that have to be paid towards nursing home care in the future. And before I dive into this trust, I might actually just skip ahead one slide, if I can, to talk about Medicaid briefly. Let me see if I can do that. Okay, yeah, so here's my slide on Medicaid. So Medicaid is a program that will help you pay for nursing home care. Now, as you'll see in my left-hand column, there's 3 ways to pay for nursing home care. You can obviously pay out of pocket. Not many people want to do that. The average cost of nursing home care in my region, so in like upstate, is about $15,000 per month. If you go downstate to like Westchester County or any of the 5 boroughs of the city, you're looking at least probably $20,000 per month. So most people don't want to pay out of pocket, at least, for the for their whole, lives, for a nursing home. The other, the second way to pay for it would be to have long-term care insurance. Long-term care insurance was this great thing that they came out with, probably, I think it's been around for a while. It really took off in the late 90s, early 2000s. That was probably the best time to get one of those policies. As of now, they're almost impossible to get. And even if you can get them, the cost for them is just absolutely insane to the point where it's not worth it. But some people do have long-term care insurance that will pay for at least a portion of their nursing home care. The third is to go on Medicaid to pay for that nursing home care. Now, again, Medicaid is a means-tested benefit that is basically there for people if you meet certain asset and income thresholds. So with that said, for a single person, you have to have under $16,000 of assets before you're eligible. If you're a married couple, the spouse that needs nursing home care is at that $16,000 threshold. And then the spouse that doesn't need nursing home care can keep a certain number of assets, and it's on a scale. You essentially take the total combined assets of both spouses and you split that in half, and the spouse can keep half up to a certain number. I think that scale that slides is between, I think it's between about 60,000 and 140 or 150,000. So not that much, because when you're applying for these types of things, they deem the assets of both spouses as, as essentially being in one pot that's fully accessible to both spouses, and therefore should be used to pay for their nursing home care. So with that said, obviously, the goal is to, not have to spend all of your money to pay for nursing home care and to be able to go on Medicaid as soon as possible, which brings us back to the trust. And I'm skipping ahead a little bit here. So that brings us back to the trust. So by setting up a trust like this, you will be able to keep assets safe from the future expense of long-term care. Again, it's a type of grantor trust, and it has a special, there's a special meaning behind that for tax purposes, but that's also what we call the people that form it. And then you appoint someone to be the trustee of that trust, and they're the ones that kind of oversee it, and they're the ones that are in charge of it once both people, or once one or both people that formed that trust have passed away. Under the terms, it always has to pay income to the people that formed it for their lifetime. That's important because that income, by being paid out, it's taxed at their personal income tax thresholds as opposed to the higher trust tax thresholds. So you're saving money on taxes that way. You cannot pay out any portion of principal to the people that formed it because they're the ones that might need nursing home care in the future. If you pay out any principal to them, that will invalidate the terms of this type of planning, and then they won't have any money that's kind of saved from the expense of nursing home care. And with that said, this trust does scare a lot of people because essentially once you fund it, you don't really unfund it. So once you put something in there, you're not usually then able to access that. If I funded it with, let's say, $100,000, I'm not going to be able to then go in and pull that money out, with some caveats. So as my slide says, you can be flexible. There's what's called a limited power of appointment, and that allows the people that form this trust to change who the trust will pay out to upon their deaths. So essentially, if I set up this trust and I'm going to leave it to, let's say, my 3 kids, but then I have a falling out with one of my kids or something like that, I can change who the trust will pay out to upon my death. So that's one power that you keep. The other power that we put into our to these types of trusts is that the trustee can make payments of principal that's in the trust to members of their family, to members of the family of the people that set it up. So if I set up a trust for my 3 kids, my trustee will be able to make payments of principal to my kids. The thought behind that being, you know, if mom and dad set up this kind of planning, but then they need some money to pay for, I don't know, things that are going on in their house. They need a new roof on their house or something like that. You can take money, so the trustee can pay money to mom and dad's kids, and then kids use that money to pay for a new roof for mom and dad. They're not giving that money right to mom and dad. So the terms of this, you know, trust are still valid. It hasn't been, rendered invalid, but it's just, again, a workaround. And then, God forbid, if we do need to undo this trust fully, there's a certain law that will allow you to do so, as long as both the grantors and all remainder beneficiaries of the trust sign off on it. So that's a pretty high bar to meet there. But the big thing, like I said, behind this trust is you'll save assets, you'll keep them safe from future expenses of long-term care. Now, I kind of want to dive back into the Medicaid stuff for just a second. If anyone's, gone through putting someone into or having someone that they know in some sort of skilled nursing home, you probably know there's a 5-year look back period from the time that you're applying for Medicaid, meaning they're going to look at all your expenses. They're going to look at your bank statements for the past 5 years. So the goal behind setting up one of these trusts is that you make it at least 5 years after setting this up before you need to go into a nursing home. Because if you set this up and then you need nursing home care in 3 years, technically anything you fund into this trust is going to be considered a gift within that 5-year look back period. So that's why it's pretty, it's a pretty delicate thing, in that you want to make sure that when you're setting it up, that you're pretty confident that you'll make it at least 5 years before needing nursing home care. So it's pretty, like I said, a very delicate balance there. I usually recommend this kind of planning for people I see who are maybe in their late 60s, early 70s. I had one woman I met with who was, in her mid to late 90s, and I told her, I was like, I'm not comfortable doing this kind of planning for you. And it's a kind of an uncomfortable thing to be saying to someone, because you're basically saying, I'm not sure if you're going to make it 5 years before you need nursing home care. But you have to be as candid and as forthcoming as possible, because you don't want them to pursue this kind of planning and then run into issues in year 2 or year 3. So like I said, very delicate thing. But if put in place at the right time, this can be a major game changer for people. In terms of assets that you might fund into this, the most common asset would be a house, because more often than not, someone's house is their largest asset, and so you don't want them to lose that. Have to have a lien placed against that house by either the nursing home or the social services office, to pay back all that money from that was spent paying for your nursing home care. So this, again, house is probably the most common asset. Another common asset would be like a stock portfolio account, something like that. I see that pretty often. You can certainly fund it with cash. If you open like a cash bank account in the name of this, and then it just kind of sits there, that's perfectly fine too. Lots of options. Any questions about the Medicaid trust? I know it's kind of like a quick and dirty overview. Happy to dive deeper if people have additional questions, or maybe have some personal experience that they might want to speak about. Certainly feel free to speak up. But hearing none, we kind of talked about the rules for applying for Medicaid already. And again, that's why we would set up that trust to avoid all this fun. Something I do get asked a lot is, if I don't do any planning and I need to go into a nursing home, like, is there anything I can do without having to spend all my assets down to $16,000? And the short answer is yes. It's called, it's essentially called like emergency planning. And through what's called gift and loan planning, we can probably save about half of your assets, but there's no guarantee. And it's a pretty expensive planning to do that kind of, last minute, let's move some things around, to get eligible sooner. So again, the better option would be to set up some type of, Medicaid trust in advance. But if you don't do anything, there certainly are options. Would certainly recommend speaking with, someone that practices in this area to talk more about that. I don't want to dive too much into those details, just because it does kind of vary a little bit from state to state, but don't fret. There are some options. Sally, I see you have a hand up maybe.
So could you explain, so you said that on the slide before this one,
Yeah,
that there's income to grantor for life. So
yeah.
When you set up the trust, would you determine at that time what the amount would be? Is it per year or?
Right. So by income, what I mean is if it's funded with any assets that produce income. So if you funded it with like a stock portfolio, those quarterly dividends that stock earns would still pay to the grantor. It's not like, certain income. It's not like they'll get $10,000 per year. It's nothing like that. It just basically means if the assets that are funded into that trust are churning out income, that will still pay to the grantors. Again, if you're funding it with just a house, there's not going to be any income likely, unless you're renting out that house. I hope that maybe answered your question.
Yes, but then if all you have is stock or other financial stuff, not a house, how does that help you when Medicaid kicks in? Because can your trustees then use that money to help you? I don't understand.
Right. So Medicaid, or the whatever office in your state, operates it, would only be able to take the income that stock is earning. They couldn't make you sell that stock. They couldn't get any of the principal value from that stock. The only thing they'd be entitled to would be that income.
But if it's financial, that means that your trustee couldn't use it to make your life easier while you're in the nursing home, because they can't give anything to the grantor.
Correct.
So it's just to save it for the next generation?
Essentially, yes.
Okay.
That's one of the main and that's one of the main purposes behind this trust, is to kind of save assets for whoever you want to pass them to upon your death. If your goal isn't to save assets, if your goal is to you use all your money how you want to use it, then maybe this type of trust isn't necessarily for you. But yeah, again, that's one of the main components of this trust, is once you fund it, the grantors don't really have any access to that principal at all, only income.
Okay. Thank you.
Yep. So we talked about the Medicaid planning again. And this is the estate and gift tax slideshow. I forget if I showed this at all. We talked about those amounts. So again, this is for 2022. The New York State estate tax is currently at 6.11. And then the federal estate tax is currently at 12.06 million. And then we do have gift tax as well to always think about. So at the federal level, you can make up to $16,000 in gifts per person per year without having to file any gift tax filing or anything like that. If you gift anything per person above $16,000, technically speaking, you're supposed to file a gift tax return. Most people still don't, but from a technical legal standpoint, you should. Again, that's a federal tax. New York State does not have a gift tax, but gifts that are made within 3 years of death are clawed back and considered part of your estate for estate tax purposes. So if I made a gift of $500,000 and I died a year later, even though my estate, I don't have that $500,000 anymore, it's still going to be considered part of my estate when factoring in whether I'm going to owe any New York State estate tax, because they always like to tax you. And I'm trying to remember if I don't have another slide, but so I talked about the two main types of trust, which is obviously the RLT and then the Medicaid trust as well. I want to just touch briefly on the fact that you'll also find trusts within people's wills. It's called a testamentary trust. That's very common if you have, maybe young parents who are doing wills and they just have a trust built into their will in the event they pass away before their child, has reached a certain age, so that money isn't going right to a minor. Another type of testamentary trust that you might see besides a trust for minors would be what's called a supplemental needs trust, or SNT. That is for people who are either intellectually or developmentally disabled. And essentially, that money is meant to supplement whatever public benefits they're on, because assuming someone falls under that category, they're likely receiving some sort of federal or state benefits. And then if they were to receive money from, let's say, their parents, that would throw them off of those public benefits. So the idea is don't pay the money right to them, pay it to the SNT instead. So those are probably two of the most common testamentary trusts that you'll see, both the trust for minors and then the SNT as well. There's also a number of other trusts that you can have. A lot of it is for people who have a high net worth. There's the charitable remainder unitrust. There's a charitable leads trust. All those are kind of designed to give tax benefits to people that, again, have a very, very high net worth and are looking to reduce their taxable estate by making charitable gifts to people. And so usually I've never done one of those. I mean, I know what it is, but those are few and far. You don't see too many of them, just based on the fact that most people don't have that kind of wealth. So I'm trying to think if there's any other trusts that I wanted to touch base on. If there's any other questions, please feel free to chime in now.
Brad, you mentioned that the trusts you just mentioned for wealthy people.
Mm-hmm.
Would the criteria be that to define wealthy? Would it be that those are people who exceed the estate tax cutoffs, and so they're say on the federal level they've got an estate worth $15 million, and they're concerned that, well, that $3 million is going to be subject to tax, and
Correct.
so that's why they're setting up those trusts.
Yeah.
Okay, I got you.
Yeah, and I don't want. And again, I mean, we could we could dive deeply into the whole tax thing, but essentially, when you make a charitable gift like that, you qualify for the charitable deduction, which essentially, reduces your taxable estate. And so by making some sort of gift like that, you essentially will have less money there to tax, and therefore you avoid paying that tax. I don't think I actually touched on what the tax rate is. So and I do want to mention that. So any money that you have above either that 12 million, or if you're in, a state like mine, above that 6 million, it's about a 40% tax. So that's kind of what people are looking at. So that's why, you know, as much as I think people should pay taxes, I can also understand why people might want to, you know, avoid paying that high of a tax rate.
Yeah, 40% is pretty high, even compared to the maximum federal tax income tax level, right?
Yeah, exactly.
I think though that if I won't mention this too much, but I think that Wells advancement people could talk about this, but there are other times when people would set up a charitable trust. I think if they simply wanted to, with no eye towards estate planning necessarily, or end of life considerations, but rather because they want to minimize the taxes they're paying while they're alive.
That is also true. Yep, because obviously any year that you're making a gift to, you know, some sort of charity, not-for-profit, whatever, that will also be able to limit your taxable income. You know, that's essentially, you can claim that on your taxes.
Well, I guess with a caveat on that would be within the limits of what the IRS allows.
Right.
There's a standard deduction which you may not exceed, in which case it wouldn't matter. And then there's a maximum that you can give above which you don't get to deduct. So
correct.
Yeah, but I understand what you're saying. Yeah.
Yeah.
Brad, sorry. Do you want me to stop recording at this time and people can just ask questions, or are you still presenting? I'm sorry.
That's probably fine. No, I'm pretty much done with the material that I had prepared. I really just wanted to touch, you know, the most on both the RLT and the Medicaid trust as well, because those are the big two.
Okay.
So I'm more than happy to have the taping stop.
Perfect. Thank you. I'll do that. And remember, I was going to say the information is on the slideshow and also on the little bio on YouTube. And people can also reach out to the alum office at wells.edu to help with these connections. Okay, I'll go ahead and stop recording. Thank you.